Welcome to Turning Hard Times to Good Times. I'm your host, Jay Taylor, speaking to you from the borough of Queens in New York City. It is the 7th day of June, 2023. I've titled today's show, John Rubino Identifies the Canary in the Coal Mine. And John will be with me in the first segment to talk about various issues that we're going to explore the issues that are facing the economy and the markets with John. And is there a canary in the coal mine that hasn't returned that will tell us that something really dire is about to happen? Or can we just, go on and enjoy life like nothing's wrong? I mean, that would be my preferred modus operandi, but I don't know if that's realistic. Anyway, John is with me right now. In the second segment today, Cherie Leeden, she's the president and CEO of Gold Bull Resources. Well, she'll be with me then to talk about the extraordinary success that Gold Bull is having. And with me also is John Woods, who is an advisor and a geologist who is credited with at least in part, with the discovery of the great Sleeper mine in northwestern Nevada. It was a mine that I'm somewhat familiar with because I was a lender at Westpac Banking Corp at that time. We were involved with the first gold loan in modern times was made, a 250,000 ounce gold loan was made by Westpac and Citicorp and a number of other banks to help Amex Minerals and Energy was the name of the company at that time, stay in business actually. And they found this incredibly rich vein that preserved the life of that company for a number of years longer. Well, anyway, John Woods was one of the people that was credited with the discovery of that great gold deposit. So he'll be with me along with Cherie Leeden in the second segment. But right now I'm happy to tell you that John Rubino is with me. Thanks for joining me again, John.
Hey, Jay, good to talk to you again.
Adam Taggart, who you were just interviewed by Adam, I think he does a great job. He likes to start out by asking his guests what their current assessment is of the global economy and the financial markets. So I know you answered that for Adam about a week ago or so, but maybe you just, for my viewers, give us your view of the global markets.
Yeah, I rambled a little bit with Adam, so I'll be more concise this time. The global financial system is a huge mess. We've been borrowing way too much money for way too many years, and now the consequences of that debauchery are starting to bite. So I think things get worse from here, and it only gets more chaotic for the balance of this decade.
Yeah, all right. Well, that's a pretty succinct answer. So what do you think? We've got this huge debt, and of course now we're talking about the debt ceiling, which has just been passed by the House, and the Senate has also passed as well. What are your general thoughts about that?
Well, the debt ceiling thing is just political theater, and but we still fall for it every time, or at least the media falls for it because it's a juicy story. But we've literally raised the debt limit like 70 times, right, since the 1980s. And every single time there's this battle between the two sides who want to cut spending or increase taxes or whatever. And they threaten to shut down the government if they don't get their way. And they always cave right at the end because nobody wants to shut down the government and be blamed for it,
right,
over something that's not real. It's just a manufactured crisis. So they did that again. The handful of interesting things about this are led by the fact that the federal government has kind of reined in its borrowing while this battle was going on. But now that they've raised the debt limit again, they're going to go back to borrowing really aggressively, and they're going to make up for lost time. And the U.S. government debt is going to jump by several $1 trillion in the next few years. So we're already at like, what is it now, 120% of GDP or something like that, which is, that's disaster level. The economists who looked at this have concluded that 90% debt to GDP is the point at where it really starts to hurt you. And now we're, 1/3 above that. And with a bullet, we're increasing our debt at an accelerating rate. So again, that's part of the whole thesis that the amount of debt that we've taken on is, has made us unfixable as a global financial system. And nobody's even trying to control it anymore. Everybody's just borrowing as much as they can. So the problems that flow from that are going to be more and more serious with time. And the funny thing this time was that even though they battled over whether to cut government spending or not, they agreed to exempt Social Security, Medicare, and the military from any potential spending cuts, and that's most of the budget. So
Yep.
we reached the point where we don't even pretend to be serious about this stuff, so going forward, it's going to be more of the same, which is to say bigger and bigger booms and busts, and until one of the busts is so big that it forces the government to bail out everybody in sight, and that affects the currency, and then we have to have the currency reset, which is basically a massive bout of inflation, followed by some kind of a new system that hopefully is sustainable, but who knows with these guys.
Yeah, well, of course, the people that are benefiting most from the current system want to see it continue on. I think we all want to see, we don't want to see the pain that's likely to come with some sort of a reset or leading up to the reset for sure. But, all of this borrowing has taken place not just by the federal government, but by corporations, by individuals, huge amounts of debt taken on. Why? Because it didn't cost anything. It was zero interest rates, or very close to it, for almost 10 years. And now when rates are starting to rise, John, it's starting to get extremely painful. I think it was Tavi Costa who pointed out that within the next 2 years, the government's going to have to refinance something like 50% of its debt. Wow. If we start having to refinance at 5% or something like that, what's that going to do to our budget deficit?
See, that brings up a really interesting point, Jay, because at some point soon, the Fed is going to stop raising interest rates. They're talking about doing it at the next meeting. And then people are going to conclude from that tightening is over. But actually, because of the mechanism you just sketched out, monetary tightening will continue as all this debt that has to be rolled over is refinanced at higher and higher rates. So even if the Fed stops raising interest rates right now, we've got years of monetary tightening ahead of us as debt rolls over and interest costs rise, and that interest expense crowds out other spending. So we're nowhere near the end of this process yet. We will not get an easing of monetary conditions or even a lessening of the tightening pace until the Fed starts cutting rates. And we're a ways away from that. We need a crisis for the Fed to start lowering interest rates. And that's kind of the box that we're in right now. Until there's the crisis, the Fed has no incentive to stop fighting inflation. But if the Fed doesn't stop, money gets tighter and tighter until it causes a crisis, So one way or another, something big is coming. And the only question is the timing. And I would argue that the timing is pretty imminent now. There are just so many things that can go wrong that one of them will blow up on us in the coming year, if not the coming 6 months.
Yeah. Okay. So I guess the assumption, John, is that when something breaks, when we have, the markets finally, plunge and everybody's scared and everybody's, it's risk off entirely, like it was in 2008. Then you expect that prices should fall, taking the pressure off of the Fed to raise interest rates or to keep them high. Then they'll be able to lower rates or to start pumping money in the system because there'll be no inflation. That's what we'll hear. We'll get a CPI print that's back to 2% or below, and so everything's all fixed now. But I'm hearing some people, Simon White, I think his name is, from Bloomberg, was talking last week about, don't be so sure about that. He said, people are assuming that that's what's going to happen. The Fed will tighten, things will get slower, interest rates or inflation will fall, and the Fed can can put the pedal to the metal again. And he's saying no, that you have cyclical inflation and you have and you have sort of sticky inflation that's sort of systemic, and the systemic inflation isn't going away. We're not seeing any indication of that yet. Although I think in the latest job numbers that came out last week, that there was some indication that some weakness in the labor market. So I suppose they're counting on on labor, not being so tight, and so that sort of systemic inflation will come down. But what are your thoughts about it? Do you think that this time will be, this time we'll be able, the Fed will be able to have another round of it and have, just go back to like we did in 2008, 2009?
Well, I think that this time around, you're right that inflation is sticky and high. The Fed's favorite inflation measure, which is PCE, personal consumption expenditures, just came in at like 4.7%, an annual rate, which is higher than expected. So that measure of inflation is actually accelerating right now. So the Fed cannot come out and say, well, inflation is over, so we're going to start cutting again. They can't do that. But when the next big crisis comes, inflation won't even matter because the crisis will be so much more immediate. For instance, if the banking system is collapsing or commercial real estate implodes and that takes down pension funds or any number of other things that, or stocks obviously start tanking. So that there are lots of things that could happen and will be brought about by interest rates going up and money getting tighter and tighter. So it almost doesn't matter which crisis comes first because it'll cause the other crises to happen at the same time. And at that point, the Fed has no choice. They can't let the banking system collapse.
Yeah.
They can't yet let housing implode. They can't let major governments around the world default because their interest costs are soaring and their currencies are tanking. They can't let those things happen because letting one of those things happen would be letting one domino fall that knocks down all the other dominoes, and you get a global financial collapse. So the Fed will have to step in at some point and just ignore the inflation rate, whatever it is, and bail out the guys who are imploding. And I think that could happen very easily, very soon with what we've got going on out there right now. Commercial real estate is a nightmare. Wolf Richter is doing a great job of tracking down the deals and showing how much cheaper buildings are being sold for now than they were sold for 2 or 3 years ago. Say, an office building was $400 million at one point. Then they put it on the market for 320 and nobody buys it. And then they take it off and put it back on at 210. And somebody finally buys it at that price. Well, there's a couple $100 million there of losses that somebody has to eat.
Yeah.
And maybe it's the investors, maybe it's the bankers, maybe it's the insurance company that owns a big chunk, who knows? But somebody has to eat that loss, and that impacts their industry. And if you've got multiple or dozens or hundreds of buildings in that same boat, I think San Francisco alone is probably worth $1 trillion worth of losses for the banks out there in commercial real estate. And then you go to New York, and then you go to Chicago, and there's lots of big cities where there's lots of real estate that is wildly overvalued on bank books right now, and those valuations will have to be realized. The new valuation, in other words, losses will have to be taken somehow, some way. That's got the potential for a big crisis that brings the government in and forces them to bail out a lot of those players, and then $500 billion worth of derivatives on the books of the big banks. What's that going to do in the next crisis? Who knows? So there's lots of things that could happen, which are big enough to force the Fed to start easing. And I think that's how it plays out. Some big thing blows up, and then the Fed steps back in and starts cutting interest rates and buying assets again. And maybe they even step in and buy equities this time around. Anyhow, all of that happens. And that completely changes the tenor of the market. We've got this giant crisis going on, which terrifies everybody. And we've got this tsunami of liquidity coming back in. And yeah, like you said, it's 2008, 2009 all over again, but with much bigger numbers. See, that's the big difference, is that, that was multiple trillions of dollars back then. Well, now we've got several times that probably. And can the global currency markets handle that, or does everybody just decide to bail on these fiat currencies? So therein lies the investment thesis for gold bugs, right? Is that you want to be in precious metals when that happens. And it's just a question of timing. Do we wait for everything to get sucked down in the next bear market and then jump into gold and silver and the related securities? Or do we just buy in now? and just be there when everything falls apart. I don't know the answer to that.
Well, we do
But
know that we do know that gold has held its own over the long period of time. And if you go back and look at the stock market priced in gold or oil priced in gold, it hasn't gone up at all. And so gold has held its value. So you can't go wrong in having a certain percentage, at least a small percentage of your portfolio on gold bullion itself, John. But here's what really bothers me. You start pumping money into the system again, as we can expect the Fed will do. Who's going to buy the treasuries? Who's going to buy those treasuries when interest rates are pushed down? Of course, if we could get to negative inflation rates, then you could have zero and actually be making money. That happened in the 1930s to a certain extent, a limited extent anyway. But nobody's expecting that to happen. In fact, the policymakers think that negative inflation or low inflation is wrong. That's why they erroneously, in my view, set a 2% target. So they want to get back to 2%, they say. But the question, John, is, I guess you were getting at it when you said the currencies are in trouble. Who's going to want to buy treasuries? As it is now, we have geopolitical conflicts that we didn't have years ago. We could live beyond our means for many years because foreigners were buying US treasuries. Well, the biggest net exporters that earn the dollars to buy our treasuries are not so friendly to us anymore. Saudi Arabia, China, for example, even Japan because of its aging population. So that's what has me bothered and why I think that the Fed I think they're going to try, as you suggested, to keep interest rates as long as they can until something really drastic breaks. At the same time, I believe you're right in suggesting that the banks, first of all, the banks are the owners of the Fed in our system anyway, right? The banks are the major banks are shareholders of the Fed. That's my understanding. So the Fed is there to, first of all, protect the banks and maybe, as they seem to do, privatize profits and socialize losses, right? Isn't that what the Fed's there to do? To make us all pay for JP Morgan's, irresponsibility?
Yes, the Fed exists to enrich the big banks and the big banks' favorite customers. And all you have to do is follow the money to see that that's true. Every time a big bank gets into trouble out there, in a functional capitalist system, you have to have failures. If you screw up, whether you're JP Morgan Chase or the grocery store on the corner, you go bankrupt. Somebody else takes over your assets and everybody learns from your mistakes. We short-circuited that process in the 1990s by bailing out every single big bank that got into any kind of trouble. And the banks know that that's the case now. They know that no matter what happens, they're going to get their year-end bonuses. Mm-hmm. They're going to be made whole, whether it's their derivatives books that blow up or whether it's their lending to the developing countries or junk bonds, whatever, whatever stupid mistake they're making right now, they know they're going to be bailed out. And you pretty much explained why, because the entity that has the power to bail them out is owned by the banks, And to take a couple steps back to the whole reserve currency thing that you were talking about, that's a tricky thing to manage, having the world's reserve currency. It's great, it's a tremendous power because everybody wants your currency. You give them electronic impulses or pieces of paper and they give you real stuff. It's very seductive. But to do it right, to survive as the manager of the world's reserve currency, you have to be very careful about what you do. You can't go stomp around the world and make enemies everywhere and use your currency as a weapon. And because eventually people are going to get sick of that, because using that currency becomes a political statement. It's no longer a neutral store of value anymore. It's something that involves different power blocks and enemies and wars, and you're making a statement when you use that currency or choose not to. And that's what's happening now. We've antagonized so much of the rest of the world that a lot of big countries are actively looking for ways to bypass the dollar. The BRICS coalition, for instance, was something that's been around for a decade and didn't really do much of anything other than, a few of the members bought some gold, but that was it. But now they're turning into a major force in global finance. Currently, the members of the BRICS coalition represent going on half of the world's GDP, and they've got other countries lining up to join.
Yeah.
And they're talking about starting a currency union with a competing currency and competing bank settlement system, et cetera, et cetera. And that's, it's not something the US can scoff at, because they represent an awful lot of natural resources and an awful lot of GDP and a fair bit of military power. So it's a real threat now. And it's the US's fault that this is even happening. We screwed up and we caused this. And now we're going to probably pay a big price for it going forward.
Yeah. I just wonder, I said, listen, governments that basically are becoming tyrannical, I think ours is in many ways. I could picture the possibility of forced treasury buying, where you're forced to take a certain percentage of your 401ks and buy treasuries. Is that, what's not on the table for a government that becomes desperate, John?
Yeah, right now, 401ks and IRAs are a multi-trillion-dollar pot of cash that the
Right.
government really wants to get at. And one way they could do that is with, a wealth tax, where they say, okay, you've got $4 million in your IRA, and these 20 people over here have nothing. We're just going to take 2 million of yours and move it over there.
Yeah.
They could do something like that, some kind of a windfall profits tax or a wealth tax.
Mm-hmm.
Or they could just say, all right, we're going to convert half of the equities in your IRA to treasury bonds. Okay. Risk-free securities. We're doing you a favor. But they're really financing ever increasing government deficits by confiscating wealth from their citizens. And that could totally happen. It's something that a desperate, crazy government could absolutely choose as the lesser of several bad options.
Mm-hmm.
So expect stuff like that. And then capital controls, you'll try to move your IRA to Switzerland or something like that, and they'll put a law in place that says, nope, money can't leave the country. And then you'll try to switch to Bitcoin or something like that, and then they'll try to stamp out cryptos. This is going to be kind of a cat and mouse whack-a-mole game going forward, where governments try to lock as much capital into their country as possible, and then confiscate it once they've got it locked in. Mm-hmm. And then the private sector and individuals and corporations are going to be trying to figure out ways to get their money out of the place that's doing that, and getting away with it up till they're caught. And it's going to go on like that for a while. But through it all, it's going to make the currency of the countries doing that less and less valuable. So that's a very inflationary environment that we're describing there. But it's liable to be part of the end game in all of this. In other words, over the next few years, that's probably going to be one of the things that you and I have to talk about is, oh, did you see this new capital control?
Yeah.
Can you believe they're doing this? That we'll be saying things like that before this is over, I think.
Yeah, no doubt. Yield curve control as well on the long end of the yield curve and so forth. Anyway, well, John, the thing is, you're mentioning governments, when they're desperate, can do almost anything. And in the 1930s, of course, President Roosevelt made gold illegal, or he confiscated it, actually required it to be turned in under penalty of, I think it was $10,000, which was a huge amount of money back in the 30s, and 10 years in jail. And I remember I actually talked to Henry Royce, who headed up the banking committee during Jerry Ford's presidency, and he told me, he says, I never could understand why the penalty for owning gold was as great as owning crack cocaine at that time, which was a big deal. And well, I think I do understand it. John, I think you understand it, because gold is a competitor with the dollar. It certainly is now, and would seem to be more reason to be owning gold than ever before in my life anyway. Given what's going on, the irresponsibility of our, fiscal irresponsibility of our government and so forth that we're witnessing in real time now. But to what extent are you concerned about gold confiscation or some laws that would say, after the government's gotten rid of a good portion of its gold, and now all of a sudden maybe it figures it needs gold to be for some sort of a global trading currency. Do you see that as a danger to people that are owning gold now, John?
Yeah, it's not as obvious as it was back in 1933, 34, because gold was money back then. Mm-hmm. So if they were going to devalue the dollar, which they intended to do, they had to take gold out of the equation, or else people would just sell dollars and buy gold, and that would short circuit the whole devaluation thing. This time around, it could happen, but some steps probably have to take place first. For instance, one interesting thing is a lot of states are starting to make precious metals legal tender, or at least non-taxable. In other words, they're defining them as money instead of a commodity. And Texas was actually considering a law through which they would set up a state-sponsored gold-backed currency for use within Texas. And I think as states kind of catch on to the attractiveness of doing one thing like that or another, then all of a sudden gold, or maybe some states choose Bitcoin too, like El Salvador did. But anyhow, competing forms of money being set up by the states, which are the laboratories of democracy, that's their job to do things like that, would be seen as a threat to the federal government.
Yeah.
And they might lash out in various ways. And one of those ways might be to make, state-backed gold-backed currencies illegal. And these gold depositories, like there's one in Texas where you can deposit your gold there and they'll keep it safe for you. Things like that might be, one step away from a gold-backed currency, and therefore the government might make that illegal too, or tax it or whatever. So there's a lot of moving parts to what could happen. And the federal government has a lot of choices when it goes authoritarian about what it can do, So we can't know ahead of time exactly what they'll do because they've got a menu. But you can bet that the more stressful things become, the more aggressive the government will become. And the more important it is that we as individuals take steps to be ready for that and to protect ourselves one way or another. So it's an interesting intellectual challenge to be ready when the government finally goes off the deep end and starts doing things like that. The difference between a bad choice on our part and a good choice is basically our net worth. We could lose everything if we get it wrong, or we could have massive capital at our disposal if we get it right. So this is a very important process.
Yeah, that's true. It's hard to know which way the government will go and what policies will be instituted in a time of crisis. But turning to what's going on now in the markets, John, it seems as though the equity markets just don't want to go down. And maybe it's just a few number of companies. It is just a few number of companies that's holding everything up. What could cause that to change? I mean, there's huge amounts of money sloshing around in the system that's been pumped in, starting with COVID, and then when Mr. Biden took office as well. And the Fed has accommodated it. That triggered the inflation, and now they're trying to fight the inflation. So there's obviously a lot of money still out there that's buying these these tech stocks, primarily these new tech stocks are being purchased it's almost like a mania, it seems. What when can we, what I'm trying to get at, John, you're supposed to be the guy that's going to tell all of my viewers now. You will tell us when and what the canary in the coal mine is. So what are you watching, and how can we know? It's really tempting. I'm a gold bug forever. And I keep saying, gee, maybe I should be buying some of these tech stocks. And the last time I did that was about 2008, John, when I was ready to give up on gold and I wanted to buy, I wanted to buy all the hot stocks at that time. So to me, that is saying that we're getting long in the tooth and this bull market is almost over. When I start feeling that way. But
well, Jay, here's how.
What are you watching to tell you that now's the time to get the heck out of the stock market completely, or maybe you buy some choice gold mining shares, or just gold and cash, or what are your thoughts right now? What should people be watching right now carefully?
Okay, well, here's how bull markets generally progress. They start with a lot of new currency creation and credit growth and everything. So the system is very liquid. People buy equities and those equities go up. And gradually, either because the Fed raises interest rates or money gets tight for whatever reason, monetary conditions tighten. towards the end, and stocks keep going up, but the breadth of the market contracts. In other words, fewer and fewer stocks are going up and pulling the overall indexes up. And then eventually you get so few stocks up there and money is so tight that the handful of stocks that are pulling the market up, they can't go to infinity, right? They have objective values. And if they go too far beyond what is a defensible value, even they roll over. And so you get tight money and the handful of big stocks that have been pulling the market up rolling over. And that's when everything cracks. And then you get a bear market that looks like it's never going to end. You have a couple of years of everything falling until nobody wants to touch those stocks that used to be the favorites, or any stocks. And then you're at the bottom. So we are now at the point where a handful of very dramatically increasing stocks have gone up and up. They pulled the market up, but there's just a few of them left now. And money has gotten tighter and tighter until it's reaching the point where in past bull markets, it's been tight enough to break the bull market and cause a bear market. And that's where we are. So we're towards the end of this process. Now, what exactly is going to cause that to happen? You only know that in retrospect. It could be some kind of a geopolitical crisis. It could be one sector or another, like we talked about, breaking because of higher interest rates, and that's scaring everybody and causing equities to drop. You can't know that. But based on history, we're towards the end of this cycle. So maybe money gets a little tighter. Maybe interest rates go up a little bit more before the Fed stops tightening. Maybe tech stocks go up a little bit more from here and their valuations get even more outrageous. But those things can't go on for too much longer based on history, because they're at the point now where in the past, the bull market is broken. So I think we're close. I think probably by the end of this year, we'll be talking about a very different economy and stock market. And what that means is that there's a big short opportunity out there for somebody who times it just right.
Yeah.
To make a huge amount of money by betting against something. I think NVIDIA, right? That just gained, what, $300 billion in market cap to become a $1 trillion stock?
Yeah.
Because of the artificial intelligence hype cycle. AI is going to be a huge deal, no doubt about it. But it's not going to change the world overnight. And NVIDIA is not, they didn't gain $300 billion of market cap this year for any fundamental reason. It's just that people are excited about AI all of a sudden. So something like that becomes an interesting short candidate because it has all the hallmarks of a bubble stock now. And let them go back down to their intrinsic value, which let's say it's $400 billion or whatever. That could shake up the speculators enough to bring on a bear market, something like that.
Yeah.
But there's a dozen things like that could happen, and it'll probably be something that comes out of the blue, like the little bank mini crisis we had here just now.
Yeah.
Who expected Silicon Valley Bank to go bust 2 weeks before it did? Almost nobody, and it just came out of the blue, and it's liable to be something like that this time around too. So the fact that something is coming is really the important thing to take away from this. It doesn't matter what it is, as long as it's something that shakes the confidence of the people that are speculating in big tech right now.
Yeah.
And we'll see. Something will happen.
Well, short selling is tempting, John. I mean, NVIDIA would seem to be, as you say, a great candidate for that. I don't know if it's, it's selling at how many times sales? I mean, like 100 times. I don't know. It's just way overvalued from what most people who are looking at it closely believe. There's no rationale currently, unless you just really think the sky's the limit in terms of what this company can do. And I would expect that there is a company, a symbol AI for a company, artificial intelligence company. It looks pretty good to me. I looked at it and I said, geez, I'm tempted. And I think they're making a little money, and they sort of have applications for almost every industry in the world. And something like that, I think, might make some sense, but not now, right? I mean, now's not the time, in your view.
Well, let's say now is 1999 with the
Mhm.
dot-com bubble, right?
Mhm.
That you could have made money for the next 6 months
Yeah.
by buying in, but um, 2002 was a much better time to be buying those same stocks because most of them were down by 80 or 90% at that point. So that's what this feels like. This feels like another one of these, bubble markets that are going on much longer than they ought to, and are tempting you to jump in and try to ride the last bit of the wave. And at some point it blows up, and at some point you're back in 2022 or in 2002 when the stocks that everybody was making so much money off of are down by 80%.
Yeah.
We haven't repealed that law of finance. We're still operating under that law, and that law says that when money starts to tighten while some things get irrationally valuable, that those two things collide and they end up with a bear market. So we're doing that. This is incredibly familiar. This looks just like the late 1990s or 2006, 2007. Only the names have changed and the numbers have grown.
Yeah, the laws of economics haven't changed. I know within the four dimensions of time and space, John, I don't see artificial intelligence. It's sort of, on the one hand, kind of frightening in some ways because there are people that have legitimate people that know a lot more about it than I do that have legitimate concerns about what it might do to humankind and all of that. That's another issue, but it has a potential to do a lot of good, no doubt about that. So it's an industry that's here to stay. I have no doubt about that, and probably some great opportunities. But to get us through the difficult times that we think, you and I believe, and most of my guests, I think, believe we're headed for, gold shares, John. And I know you have some that you really, really like a lot. One of them that I'm not as familiar with as some of the others is Nevada King. Other than I've seen, they have, it looks like large scale potential, and they're getting incredibly high grades of gold. Talk to us about Nevada King for a little bit. Why do you like it so much?
Well, I think a lot of these juniors, or some of these juniors, are doing some really interesting operational stuff out there, and it's being kind of obscured by the fact that the market isn't very favorable for junior miners right now. But a handful of them are reporting some amazing drill results, and Nevada King is one that just kind of came out of nowhere. But they've accumulated a big land package. They're the third biggest landholder in Nevada, which is a historically favorable place for miners. And lately, they've been drilling and finding ridiculous amounts of gold.
Mm,
100 gram meters
yeah,
um,
really
is
common.
normally that's a really good drill hole, right? And they report multiple results like that every month now, it
Yeah.
seems. So they're putting up numbers that are very rare and very impressive. And if that continues, then they become a major takeover candidate. Some big miner swoops in there and pays a big premium for them. I think they're getting to that point right now just because the numbers that they're putting out are so impressive.
Yeah.
Um,
How have the shares held up there, John? I haven't, that's one I don't follow, but I know I need to.
the shares are up. Well, I bought some at, okay, I want to say 25 cents a share.
Uh,
And then I put a new order in around 27 cents a share. And now it jumped up to 35 cents a share
mhm.
just, within a couple of weeks.
And that's in a
And so
bad
I'm waiting
market.
for it to come back down. Yeah.
Yeah, that's in a market where gold shares haven't done anything.
Well, yes.
Obviously, that's
I,
standing out.
I mean, it's in a market that's not favorable right now.
Mhm.
And they just did a big financing. They just I think it was equities that they sold, but it might have been debt. I don't remember the details of the financing. But that's the kind of thing that normally knocks your stock price down a bit if you're a junior miner,
Yeah,
and it had no effect.
yeah. Well, that
So
tells you something for sure.
yeah, it means the results that they're getting with their drilling program are so impressive that they offset a bad overall market and a big financing. So yeah,
Mhm.
um, that's one to watch. I mean,
Yeah,
there could be one of those equities bear markets that pulls down everything, and even something
yeah,
that's putting up results like Nevada King get knocked down. That's a possibility, but operationally they're doing great, and they're probably if they have another year like the last year of drilling, then they're incredibly undervalued. So something to watch, something to nibble at. Don't jump with both feet into any junior miner, but I think something that seems useful to me is to buy a little bit of something that looks interesting as a way of getting your attention, because you start paying attention to it once you own it and you learn about it.
Yeah.
And if the things you learn reinforce your original optimism, then you have a better basis for buying more going forward. So, my advice would be to buy a few shares of Nevada King, very cheap, penny stock almost, and then watch it.
That's one I want to look at, John, because that's in the U.S. A couple of others I believe you know about are Newfound Gold and Snowline Gold. Both of those are Canadian companies. Both of them are on to world-class discoveries, absolutely multi-million-dollar. I think Newfound or Snowline, I should say now, has B2 Gold. There's a major shareholder. They're obviously a very successful gold producer. They have in mind, probably working with Snowline and maybe even taking their projects into production. The one they're working on now that have had so much success. But both of those are Canadian companies. And what that reminds me of is an article that you wrote on Substack talking about potential troubles for miners. And I think there were 3 issues that you brought out. Would you care to mention those 3?
Yeah, I'm not sure I remember all 3, but the biggest one is that, the first one is for the big existing producers right now is that their resources are diminishing. In other words, the grades that they're getting aren't so good, and their production is starting to drop. Because we have been looking as humanity, we've been looking for copper and silver and gold and other metals for 3,000 years, and we found most of the low-hanging fruit. So today's deposits aren't as good as the ones that were mined in the past. And that's a problem for the big miners because they're taking a lot out of the ground, but it's getting more expensive to do so. And so if they want to keep on making money and, be rewarding their shareholders with dividends and a rising stock price, they got to find a way to either raise the grades that they're mining or take a lot more out of the ground. So production or grades, one or the other.
Yeah.
Another thing that's an issue for the big miners is that a lot of governments around the world are looking at miners as sources of funds now. So they're changing the taxes that apply to miners or the royalty agreements between the miners and the government and everything. And it's to the government's benefit and at the miner's expense. So it's not as profitable to produce historical numbers, that's historical grades and costs in a lot of these places as it used to be.
Yeah.
And that's a problem for the big miners. And it could be that that changes the investment calculus as far as big miners go to make the physical metal ETFs more interesting because they benefit from rising prices that flow from the troubles that the big miners are having, Now, the other thing the big miners might have to do is buy out a lot of juniors in order to get the new reserves that they need in order to keep working. And that's great news for the juniors. And that virtually guarantees a big M&A binge at some point in the mining industry. The big miners are just going to swoop in and buy out everybody who's got a half decent deposit.
John,
the question. Go ahead.
No, go ahead with your thought.
Well, I was going to continue with what you were saying about Canada. Political risk has become an issue in a lot of places where it wasn't before. And Canada used to be this great jurisdiction for mining. Even though they were a high tax country, they liked natural resource industries and they protected them and took good care of them and encouraged them. And not so much anymore.
Yeah.
For some weird reason, and I can't explain this, the countries of the old British Commonwealth are going authoritarian at an accelerating rate. That's impressive for even this world. Australia, New Zealand, and Canada are incipient dictatorships now. They're really shocking. It's how fast it's changed. And that is potentially going to apply to the mining industry and to the Canadian miners that we used to think were in great jurisdictions. Now, not so much. Now it's not that certain. So that's
Right.
an issue with Snowline and with Newfound Gold. Even
Exactly.
though they're putting up phenomenal drill results.
Yeah.
And I own both. I'm optimistic about both of them operationally, and it's just a question of whether they're in a place that is attractive enough to make it worth Newmont or somebody coming in and buying
Right.
them out.
Right.
That we'll have to see.
Of course, Canada's different. The provincial governments are, they have a certain amount of autonomy themselves. And I was just reminded that I think it was last week or just recently that the province of Alberta passed some laws or put in a government that's a conservative government. And so it's, the government that was trying to take over or to retain power there was going to increase taxes on energy, on oil and gas. I think increase the oil and gas taxes to those corporations by 35%. And my friend, my relative actually, who told me about this, said that they're resting easy now again, and getting excited about some of the Alberta oil and gas producers again. But so I say that with Snowline, it's over there. It's over there in one of the eastern provinces over there, and then you have no, Snowline is up in the Yukon actually. So maybe there's some difference between the provinces, is what I'm trying to say. But it is a concern, and so Nevada King is in Nevada. We'll see how things go here. There's also quite a few people in this country that would like to see miners taxed, and it's sort of funny, the people that want the Green New Deal people want to have all this clean air and CO2, taken away, and they don't realize that they're going to have to create a lot of CO2 to get the metals you need to do this stuff. So I don't know. A lot of this doesn't make any sense to me. But John, I see that Nevada King is certainly one I want to watch, and it's in the States and Nevada. There's an awful lot of interest in Nevada to mine because there's a lot of money flowing into that state from that. So Democrat or Republican, I suppose, there's a vested interest in keeping that going. So I don't know, any last thoughts, John, about what we should be watching now coming up next week or so? How close are we to some sort of a meltdown in the equity market, or could this just go on and on and on?
Hey, Jay. Well, I think watching interest rates is what we should
Yeah.
be doing right now. The 10-year Treasury note yield is a very big deal because so many things key off of that.
Yeah.
And it's gone up enough that mortgages in the US are now at 7%.
Yeah.
And that's the death knell for the housing bull market for sure. I mean, house prices are at record highs, which make them unaffordable just based on price. And now financing costs are way up. So that the average family can't afford the average house in the US anymore. And that's usually when the cycle turns.
Right.
So, interest rates apply like that to a whole bunch of different sectors out there. When financing costs go up, activity either declines or just ceases in a lot of cases. So if interest rates continue to rise, which they have been lately, that's a very big deal. And that could be the thing that pushes us over the edge here. So yeah, pay attention to interest rates and just monetary tightening in general, because I think that's the key part of the environment now. When that gets unbearable, then the system will break.
Interest rates, John, and for houses, and I think the canary in the coal mine that you talked about on Adam Taggart's show is road vehicles, right? RVs.
Oh yeah. That's kind of jokingly called the RV indicator, and that's might be better called the big toy indicator. In other words, when things have been good for a long time, you can justify buying that boat that you've always wanted. And then you've got to have the jet skis that go with the boat, so your kids will want to come out with you. And then after you've played with the boat for a couple of summers, you start thinking, man, wouldn't it be nice to be a snowbird? And then you buy an $150,000 RV or something like that. And that's the point where the economy breaks, usually. After you've had that many years of reasonably good times, and you're that cocky, that you think it's a good idea to buy a house with wheels that you're going to drive from one place to another instead of just flying somewhere and booking a nice hotel. that's usually a sign that we're late enough in the cycle that that it's ready to turn. And RV prices and sales have gone up dramatically over the last few years, and now they're starting to roll over. You're starting to see some good deals out there on RVs that were, $120,000 marked down to 89,000 or something like that. That's nowhere near the bottom, but that trend change indicates that indicator of overconfidence is about to break.
Right.
So that matters. That's something to pay attention to too. And that's easy to look up. Just go online and look at RV prices out there. And when you start seeing a lot of price reduction notices, then you're heading into that part of the cycle.
Yeah, that was the canary in the coal mine that you mentioned. And I guess we'll be watching interest rates. And even if rates stay where they are now, there's going to be a lot of companies and the government's going to have to refinance individuals. Credit card rates are record highs almost now. So, obviously this can't go on forever. And the best, I guess, in summing up, John, the best is to build some cash, have some cash ready to buy some things when they're cheap, have some gold, and maybe speculate a little bit with some gold shares in safe jurisdictions. Is that sort of summing up your views?
I think you always want to own precious metals across the spectrum. In other words, physical gold and silver stored safely. And then you want the best quality miners that you can find out there. And among the larger cap players in this space, it would, in a lot of cases, it would be the royalty and streaming companies. And then with the capital you have left over, you can play with that. And the junior miners are sometimes lottery tickets. You buy something. You and I watched Great Bear Resources for a few years there, and it went from 39 cents when I first saw you mention it in your newsletter to $23 in the space of a few years. Now, you don't need too many of those to completely change your life financially. So you should always own some really good quality junior miners, just in case they turn into the next Great Bear. And the three we mentioned today are all on that list.
Definitely.
Yeah,
there's a lot more of them, I know, John, and I think you write about them sometimes in your Substack articles. So where can people, I guess, to sign up for your letter, where can they go? How do they do it?
Yeah, I'm at rubino.substack.com. And in that newsletter, I cover a lot of the stuff we talked about today with a lot of actionable ideas.
Absolutely. Well, thank you so much, John, for spending so much time with us. It's always great to have you on the show, and we'll look to do it again sometime, hopefully.
Great. Thanks, Jay.
All right, folks. Well, don't go away, because Cherie Leeden, she's the CEO of Gold Bull Resources, and her geologist, John Woods, will be joining me as well in just a moment, so don't go away. Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm happy to have Cherie Leeden. She is the CEO of Gold Bull Resources with me, as well as John Wood, a geologist, and he helps the company technically, technical advisor to the company as well. And he was involved with an incredibly high-grade gold mine that I know something about, the Sleeper Mine in northwestern Nevada. As it turns out, it's on trend with Gold Bull's project as well. And that's one of the reasons we wanted to have John here. Well, thank you, both of you, for joining me today.
Thank you, Jay.
Yeah, thanks for being here.
It's it really is interesting. The markets are just terrible these days, I must say. You have 494,000 ounces of gold, and nobody wants to pay a nickel for it. 494,000 ounces. Your market cap is $5 million, more or less, in US, where I bought it 5 cents a share right now. GRBC is the symbol in Canada, GRBCF in the United States. But I've been around these battles for many, many years, decades, in fact. And I can say that, times like this is when smart investors make money. They find good underlying value, intrinsic value in the projects, and these little sleepers, they can be big winners. And so I'm really glad both of you could join us today. So Cherie, you did a scoping study recently, and the results were pretty good. I mean, it's a 494,000 ounces, small project, obviously, but 101% IRR. I think it was 100 and over 100 million NPV at 6% discount, 1.1 years payback, and producing 35 to 40,000 ounces a year. I guess there's some talk of you actually putting this project into production at this small scale. I guess I'd like to start out by asking you why you think you could make a success of it. I don't know if you do. I don't think you've reached a conclusion that you're going to go into production yet. But if you do, and I guess the idea is to use the cash flow from that to finance the hunt for the big elephant, that the sleeper-like elephant that you're looking forward to trying to find. But maybe just comment on the economics. Why, with an average grade of something like 0.73 grams, does the project seem to work?
Mm-hmm. Well, at the current gold price of circa 2,000, 0.73 grams a ton with a low strip ratio is actually very attractive for a small scale cash cow operation. And our scoping study looked at 35,000 to 40,000 ounces per annum. For us, that's not the end game by any means, but an operation of that scale has the potential to spit out about $30 million per annum. And for us, that would essentially fund a really significant exploration program in the district. And that's what we believe the district requires. For a startup of that caliber, it's also got a modest capital requirement of less than $30 million.
Oh.
So it all seems pretty doable, especially when debt is available for US gold projects. So based on the positive PEA, our board has made the decision to skip the PFS and move directly to the feasibility study on that small scale operation. And we just want to reiterate, it's not the end game for us, but what other junior is producing, 35,000 ounces per annum would really differentiate us. And it's not rocket science to get these things into production. It's conventional heap leach. Our PEA's got very conservative assumptions. We presumed, very shallow pit wall angles, 70% recovery, and we believe it will be better than that. But all those aspects will be worked out in the feasibility study.
Yeah, I think I don't know if you mentioned the stripping ratio. I believe it's pretty low there.
Yeah, it is very low. The strip ratio is 2.2 to 1 for the deposits, and it's got we did it at 1,800 gold price, and it has 145 million US NPV, and at the current gold price, it's 192 million. So compared to our market cap, it's just this massive disconnect. And fortunately, we do have supportive major shareholders who are completely backing the strategy to basically let's dig some out, let's dig some gold and make some money and put that back into exploration. Our team are mine finders. And we've got advisors such as John Wood that's assisting with our exploration efforts. So although the market isn't rewarding exploration at the moment, it's not like we're doing nothing and sitting idle. We're using these low cost new technologies that John will share with respect to buddingtonite and soil gas to essentially use this quiet period in the junior gold space to define our robust drill targets. And as you've seen, Jay, when the market turns back on, it turns on quickly. And then we're going to know exactly where to put the rig. And we're using that time. We've got Regina Malloy's our exploration manager, Will Strong's our geologist on the ground that's zapping these rocks with the spectrometer. And now we're doing the soil gas next week. So there's a lot happening behind the scenes on a shoestring budget at the moment within Gold Bull.
Yeah, so you have strong shareholders, and that's obviously very important to get you through these days when you're raising money in the capital markets. Not so easy to do, to say the least. Cherie, you have potential to expand there. I'd like to ask you about that, to expand the current resource, and then maybe John could jump in and talk about the bigger picture, the bigger geology, the larger scale geology, because as I understand it, it is part of the same belt of rocks that stretches up to the sleeper. And you are, as I understand it, the both of you really on the hunt for the next sleeper. But maybe first, Cherie, if you want to start out by just explaining the current, the geology, the potential to expand the resource. As I understand, it's open in various directions.
Mm-hmm. Yeah, so our circa 500,000 ounces is split between 4 small deposits at Sandman. and Sandman's located about 25 kilometers to the south of the Sleeper deposit. So we've been looking at those existing deposits, and yes, most of them are open, but the reality is that the cost of adding ounces right now is probably more than it is to acquire ounces in the current market. So that's why we've paused. It's a sad reality. That's costing about USD $1 million to add 100,000 ounces. So you want to add, this is all ballpark numbers. You want to add 500,000 ounces. That's about $5 million. And right now we can buy ounces. We can buy struggling companies similar to ourselves, probably for less than that. So we've put a halt to the drilling, just given the current market conditions. And we're actually looking at some M&As right now. I'm very busy on that front because we're still very much focused on the Sandman. So if you essentially draw a circle around Sandman about 20 miles, that's our focus. And if we can add ounces cheaper than we can drill them, why wouldn't we in this current depressed market? So it's a twofold approach to adding ounces. Exploration success is what John's focused on and Regina are working on. And then I'm looking at adding those ounces and adding to the portfolio in a very low cost manner that essentially uses this downtime to our benefit as well.
Interesting. So I guess one of the things investors should be on the lookout for is M&A news, potentially?
Yeah, for sure. I'd be disappointed if there wasn't M&A activity in the next month or two.
Yeah.
But yeah. Obviously, nothing guaranteed, but that's what I'm focused on right now.
Yeah. So you had some news coming out this last week that caught my attention. That's the reason I wanted to have you on this week to talk about something called buddingtonite and how that might help you pinpoint or vector into the source of these this mineralization you're seeing, low-grade mineralization you're seeing on surface. Would you like to explain that? Maybe John can jump in on that one, and because he's very familiar with it.
John is essentially the geologist who discovered the Sleeper deposit. So we're very grateful to have John as an advisor to our company. And John is the one that suggested we take a look at this. So on that note, I'll pass over to John to explain what buddingtonite is.
Okay.
First, I should probably go through my experience at Sleeper. It took about 3 years and 34 holes to actually hit the high-grade structure there. And it took a lot of complex metal zonation and mineral zonation to figure it out. But we did discover over 1 million ounces in a small body of rock, which was 3 chutes that was less than 500,000 tons. So it's very high grade.
Yeah.
And we put it in production with a small 1,000-ton-a-day mill and a heap leach for only $25 million, which I was impressed at the time. Of course, inflation, that would be a lot more now, but it was very cheap to put in production. And a lot of it was oxidized. And so it became the highest grade open pit gold mine in the world for about 3 years. At the end of the mine life, it produced about 2.2 million ounces. So what we've been trying to do is take attributes from Sleeper and apply them to Sandman, although they're very similar deposits in some respects. In other respects, in morphology, they're very different. So we decided this year to try buddingtonite. It's an ammonia feldspar, and it forms at Sleeper a relatively small envelope, a halo around the highest grade gold. So even early on, this was kind of a late choice because there's no evidence there's any buddingtonite at Sandman. But when we looked at the outcrop, buddingtonite actually looks almost exactly like a similar mineral adularia, and there's lots of that at Sandman. But buddingtonite is slightly softer and alters a little more easily, so it tends to look like chalky adularia, right? So you can identify it with your eyeballs, right? You don't need spectrographic equipment. But there's also a lot of altered adularia. So the spectrographic survey that we're doing to look for buddingtonite is almost essential to have a quantitative analysis of this, right? So if we apply this the same way we did at Sleeper, we're going to look for buddingtonite anomalies with and above parts of the gold vein that should have some of the highest grades, right? And to a small extent, that seems to be working. We're still in the process of collecting data just for the near-infrared spectrometer that we use to measure this. And this is all new technology. Like when I worked at Sleeper, none of this equipment was available. So you had to use an eyeball, and most of the time, or at least half the time, you're wrong, right? So it's good to have a quantitative analysis of this. And the main purpose of this is to look for blind deposits and to drill along structures where you have the highest probability of hitting the high-grade gold and not just a half a gram or 1 gram, right? Because most of that area at Sleeper doesn't have buddingtonite. So this is a better discrimination tool than most, right? So mixed with that, we plan on a soil gas survey, and we're going to analyze for ammonia in soil gases, right? So the first step is nearing completion. So I'm kind of encouraged because the mineralogy we're seeing with our spectrometer indicates that Sandman is actually very similar to Sleeper, right? In the chemistry of the fluids, and also in the geologic process that formed the high-grade Sleeper zones, because we have buddingtonite in the Abel-Null breccia pipe around the highest grade interval. We have an outboard anomaly of it, so it looks like it could work, right? So that's where we are now. And when we do the soil, so we can go out and measure float with this on structures that have never been drilled adjacent to where we're drilling and interconnecting structures, and look for buddingtonite just from the float because there's very little outcrop in places, right?
But the machine that measures this, it's just like a handheld gun that zaps the rock, and it essentially tells you whether it's there or not, which most geologists would probably struggle with the naked eye. So the technology is very portable, and we can cover a lot of ground on foot. So yeah, it's a wonderful vector to essentially get us to where the high grade zones are likely to be beneath, especially given the sand cover we have at Sandman.
Yeah, so your geologists can walk across the structure, and when they get the real high grades, that might be a point where you put the drills down, huh?
Yeah, you got it. It's essentially just another layer of data that we're using on top of the geophysics and the geochem. But we've got a lot of geochemical anomalies, and this is a ranking tool to essentially vector for these high grade Sleeper style loads.
Yeah. I could ask either of you, what's the distance between Sandman and Sleeper? How far apart are you?
It's about 23 kilometers. I'll share a screen that illustrates the proximity.
So is that entire area? I mean, between the two, are there potential targets all along there?
We're certainly going to be exploring that area for now. We're focused within our Sleeper folio, sorry, Sandman folio, because it's about a 30 kilometer by 10 kilometer wide zone. And there's been very, very little exploration outside the known resources. So outside the known resources, there's a real lack of exploration. And I attribute that largely due to the unconsolidated sand cover, which has been a hindrance for exploration. So with the buddingtonite spectrometry, in addition to the soil gas, which we don't know anyone else that's actually looking for ammonia, as John said. I think that's John's great idea. So we're really looking forward to seeing what comes out of this soil gas program, which is commencing next week.
So, Cherie, do you have your drill plans set up yet this year, or is it something that's still in progress?
So we don't have a budget allocated to the exploration drill program for now. For now, we're using this year to define drill targets, and we're certainly going to be focused on this soil gas program, presuming that the orientation survey is a success in parallel to the buddingtonite search. And our current funds are more allocated to the feasibility study aspects of Sandman. There's some long lead items that we're looking at. The drilling that is required this year relates to metallurgical drilling for the feasibility study. So that the feasibility study main component is going to be additional metallurgical test work, which is required for us to get to that decision to mine and post feasibility study would be the permitting under what we believe will be an EA to be essentially be shovel ready at the project.
I think there was a long section, Cherie, that you had potentially were going to show us, or maybe it's a model of the system.
Mm-hmm. So this model has been shared by actually another junior, and we think they've done a good job in actually illustrating what buddingtonite is all about. So we're going to share their cross section.
Okay.
So can you see that?
Yeah, sure. Well, I'm seeing a lot of different slides right now. I'm not seeing that one per se. No, I'm seeing a whole about 20 different ones.
Yeah, you'll have to open it. Yeah.
There we go. Now I'm seeing it. Yeah.
Okay, good stuff.
Okay.
Yeah, so this is essentially what John was describing in a schematic, but the relevance of the buddingtonite is essentially the vector to that high grade precious metal horizon. And, a lot of the other elements that we see in the geochem, for example, arsenic could be related to gold, but it could be related to hydrothermal fluids that weren't carrying the precious metals. So we believe, based on the sleeper analogy, that if we've got the buddingtonite, we're essentially proximal to the gold mineralization.
Mm-hmm. Interesting. Well, we'll be watching, that's for sure. And when do you expect you might start drilling?
So this for the next 2-3 months, it's going to be very much focused on defining those drill targets.
Okay.
So there will certainly be news coming within those couple of months. We've got our 43101 for our PEA expected next week. And then after that, look out for any M&A activity and exploration updates from this soil gas activity that we're going to be doing and defining new targets outside the known resources. So there's a few different mechanisms for the company's growth in the coming months, and that's essentially looking at the feasibility study of the known gold in parallel to conducting the exploration, looking for the new targets. There's just been a real obsession and distraction with looking at the known 4 deposits. And we want to almost, and from an exploration perspective, ignore those 4 and look outside where there's sand cover and where there could be new sleeper discoveries lurking that just have been completely neglected by the previous explorers. But there's been a distraction because the other deposits are sticking out of the ground. So they're the easy ones. The geologists aren't going to miss those ones. But I think the more exciting exploration potential is going to come out of this buddingtonite and the soil gas work underneath the sand cover, because the majority of the area is sand covered, and it's not a thick sand cover, but that sand does obscure any other deposits that are not sticking out of the ground because of that cover.
Mm-hmm. I don't want to ask you something I shouldn't ask you, but if in terms of M&A, would you be looking in the same area? Possibly?
Very much so. Very much so.
And John might have a role to play in that, probably help you scope, find some things.
We always run things past John to get his opinion, that's for sure.
John, any comments?
No, I think that covers that. I have great hopes for the soil gas survey. They're not very common because it's hard to interpret them. But since we have a breccia pipe at Able Knoll, and these things, an old word for breccia pipe is I can't remember the term now, but they're venting vapors from igneous rocks and sources deep in the earth. So they're a chimney. They were in the old days. They were called a chimney.
Yeah,
especially in certain rock types.
Yeah.
And so you can imagine a chimney smoking, right? And even though the smoke is invisible, right? We don't need to actually on something like that to find ammonia. Just the organics and things and sulfur compounds naturally venting from the earth will be be much greater, right? So if there are any other hidden breccia pipes in the area or large breccias, which there are some in the conglomerate beds around the deposits, we might actually get lucky and find a new deposit that way.
Oh, very interesting. Well, I think this is obviously not many people in the market think it's a very exciting story at this point. You're going to have to probably come up with some really exciting news, some good drill holes, maybe an M&A story, whatever. But now's the time to do your homework, folks, and learn as much as you can about these wealth creators, because little junior mining companies find these minerals in the ground that create wealth. Actually, it's the start of a modern economy. Cherie, I'd just like you just take a minute perhaps and talk a little bit about your background and Craig Perry, I think, who's your chairman, and maybe just remark in general about your board of directors, because I think that's important. I'd like
Absolutely.
to know you have a strong management team, and then of course John is helping you. So
Craig Perry is our chairman, and Craig and I met while we were both working for Rio Tinto Exploration over 20 years ago. So both very big company mentality and looking for big deposits, but now obviously in the junior space and working with a shoestring budget to try and achieve those similar objectives without the bureaucracy that comes with working for a major. Also on our board is Walter Coles, and Walter is the CEO of Skeena Resources. Yeah. And Skeena Resources have just had a fabulous run at their Eskay Creek project, which they acquired that from Barrick. That was a Barrick non-core asset, just like we acquired Sandman from Newmont. It was a non-core Newmont asset. So we're really hoping to, essentially that's our role model, is the success that the Skeena team have had recently, and we're certainly hoping to follow their great footsteps. We've also got Mike Cowan, who runs a resource-focused fund on our board, and Vince Sirachi. So a lot of experience on the board and within the team, and our exploration manager, Regina Malloy's, she's ex-BHP. So again, that major background, and we're certainly looking for significant deposits. Our target is generally circa 1 to 3 million ounces. Otherwise, it's just not essentially worth our time to be exploring for it. And we like this corridor. We do think it's underexplored. If this was Australia, it already had been, RAB drilled on grids under this sand cover, and RAB drilling, percussion drilling just isn't common in Nevada like it is back in Australia. So we're using some Aussie techniques. We've already announced to the market that last year we did a lot of lag sampling, and the lag sampling was an effective geochemical technique, looking underneath the sand. And now we're going to essentially add this buddingtonite technology and the soil gas technology on top of that to essentially vector and narrow down our targets. So we've got the problem of having too many targets for our funds. So it's a nice problem to have, but it's also one that we need to approach in a scientific manner to essentially work out where we do put our limited funds when it comes time to drill them.
Yeah, so you have people that have worked with, yourself included, that have worked with major companies that have to think big. You're a $5 million market cap now, and if you're able to find something big, it's not going to be a $5 million market cap going forward, Cherie. And well, we'll be watching, that's for sure. We'll be watching very carefully this year.
Thank you, Jane.
As the news unfolds, and I want to thank both of you, John and Cherie, for taking the time to share your story. Those that are listening might be very glad they did. Thank you so much.
Thank you.
I appreciate your time. Thanks, Jay. Thank you, John.
You bet, both of you. All right, well, folks, that's all for this week. Next week, David Stockman from the Reagan administration will be here to talk about the budget. And he doesn't have too many good things to say about the way the United States is spending money. And that definitely is related to the investment world, as you know. So until next week, goodbye, and God's blessings to you.
All financial advice provided on this show is for entertainment and educational purposes only. The financial ideas and strategies discussed are only provided as a starting point for a conversation about money matters. With regard to your particular investments and financial strategies, consult your financial planner, CPA, or investment professional. All your financial decisions are yours and yours alone to make, and subsequently are solely your responsibility. The information that is supplied through the context of the radio program and any repurposing of its content by the host or network is a combination and collection of solid financial investment understanding, opinion, and comments. This network, show, and its its host are not liable for financial strategies, outcomes that you employ in any manner that result in any kind of loss. Shares of corporate sponsors may be the subject of buy or sell recommendations in Jay Taylor's newsletter in accordance with Jay's objective opinion.